Hello and welcome to the latest episode of Millennial Money. My name's Damien Fahy. Now this week I'm going to answer some of your questions regarding jargon. So we do a midweek market show where I talk about investing and what's going on in investment markets, and I know a lot of you do listen to that, but there's a couple of pieces of jargon that even I slip in occasionally. So there are two that I want to start with, and that's bullish and bearish. Now these animal terms, what do they mean in terms of stock markets? Now bullish is a term that's used to describe a positive movement in stock markets. Now, if you think about the names come from the animal's actions, apparently. There's lots of different theories where the terms come from, but if you think about the idea of a bull, when it actually charges and attacks, it's lifting its head up, whereas a bear is clawing downwards. So a bullish market is one where the market's pushing upwards, so there's some positive momentum. There's also a definition whereby it's a 20% rise from a recent low. So that could be defined as a bullish market or bull market. But the term is generally used interchangeably between that and a positive environment. Now, a bearish market is the opposite. So if you think a market that is bearish, that tends to mean the market is going downwards. It doesn't have to be in a straight line, it's just a general pattern. It's moving downwards. Now, a bear market is typically defined as a 20% fall from a recent high. Now, you can see that you get this interchange between bull markets and bear markets. All you've got to think about is a bull market is a good market for investors as the market is rising, whereas a bear market is a bad environment for equity investors. Now, another two terms that you often hear spoken about are dovish and hawkish, and it's typically to do with monetary policy, and by that I mean interest rates. So you think about the Bank of England, and people will call somebody hawkish if they are or have a view of raising interest rates. So they think monetary policy is going to be more aggressive and rates are going to go up. So they would describe someone as hawkish. Somebody who is dovish is much more likely to be cautious and veer towards cutting interest rates. So you get, again, the opposite. Somebody is hawkish or somebody is dovish. So often after the monetary policy meetings that happen typically every month, not quite every month, but almost every month, where the Bank of England sets the interest rate that dictates a lot of things in the economy, including has influence over savings rates and mortgage rates, you sometimes hear them described as being dovish or hawkish. And if they're described as being dovish, that can give you a hint that possibly in the future you could see some interest rate cuts. But if they're described as being hawkish, then it could mean that rates could go up in the future. So that is it for this week on Millennial Money. If you've got any other terms you want me to explain, then do send them in. Do try and keep an eye out for them in the news and any papers that you read. So if you want to send in any questions or suggestions, then you can do so to damien@moneytothemasses.com. Don't forget to follow us on YouTube, also on Instagram, and of course join our Facebook group at facebook.com/groups/money to the masses.